All right, let's talk about Wells Fargo. This is the bank that literally helped build the American West. I mean, a true legend in finance. But it's also the bank that was behind one of the biggest, most shocking scandals in modern banking. A scandal so bad it almost brought the whole company down, until one outsider stepped in to try and save it. This is a wild story of gold rushes, bandits, hostile takeovers, and just massive fraud.
So to really get your head around the scale of what happened, we have to start with this number, 1.5 million. That is the number of bank accounts, checking accounts, savings accounts, that Wells Fargo employees opened completely without customers knowing. Just think about that. It's a staggering figure, and right away, it tells you this wasn't just a few bad apples. No way. This was something rotten, deep down in the core of the company.
And you know what comes after fraud, right? Fines. Big ones. Regulators came in and slammed the bank with a $185 million penalty right out of the gate. But as you're about to see, this was just the beginning. This fine was really the first time the public got a look at how terribly, terribly wrong things had gone inside one of America's most trusted banks.
I actually saw a little piece of this culture myself firsthand. Back in 2013, I walked into a branch just to open a simple account. So while one banker is getting my paperwork ready, another one, she literally swoops in, grabs me and pulls me over to her desk to steal the sale from him. The first guy comes back and he is furious. I just remember thinking, damn, these employees are cutthroat. I had absolutely no idea that this exact pressure was fueling a criminal enterprise all across the country.
So, how did it get that bad? Well, by 2016, the whole story just exploded. This wasn't just a case of aggressive sales tactics. Oh no, this was a full-blown criminal empire, and it was all built on a toxic culture. The relentless, crushing pressure to sell, it led directly to millions of fake accounts. And the fallout from all of it was about to shake the bank right to its foundations.
I mean, just look at these numbers. They're mind-boggling. 1.5 million fake bank accounts. Over 500,000 fake credit cards. But the real story here isn't just in those big numbers. It's in the fact that 5,300 employees lost their jobs over this, which tells you how widespread this was. And maybe the most damning part of all? When employees with a conscience, people like manager Claudia Pondeleon, tried to blow the whistle on the fraud, they were fired. So the system wasn't just broken, it was actively designed to punish honesty.
And all of this just raises a massive question, right? How does a 170-year-old institution, a symbol of American stability, end up here? To really understand the fault, you got to go all the way back to the beginning, back to its origins in the smoke and chaos of the California gold rush.
So, way back in 1852, two guys, Henry Wells and William Fargo, they secretly start this company to cash in on all that gold rush money. And while other banks were failing left and right during financial panics, Wells Fargo stood firm. They built this reputation for being rock solid, totally stable. Their iconic stagecoaches became the lifeline of the West. So from day one, their entire brand was built on one single idea: unbreakable trust.
And this slide just lays out the contrast perfectly. The old Wells Fargo was legendary. They hunted down bandits who dared to steal their gold, and they used brutal force to send a message, "You don't mess with us." Fast forward to the modern Wells Fargo, and they became the ones betraying their customers. They pressured their own people to basically steal from the very folks they were supposed to be serving. That original promise? Completely shattered. So, how on earth do you get from protecting gold from bandits to opening fake accounts? Well, the answer is found in a century of just relentless, nonstop growth. A whole series of massive mergers created this coast-to-coast behemoth, and somewhere in that process, the seeds of its own downfall were planted.
Okay, the one concept you have to understand to get this whole scandal is this: cross-selling. The idea itself is simple enough. You just try to sell as many different products as you can to every single customer. But at Wells Fargo, it became a dangerous obsession. It was all summed up by this internal company mantra: 8 is great. And let me tell you, this wasn't some friendly goal. It was a relentless demand that turned employees against each other and created the perfect engine for a toxic culture.
And this strategy got put on steroids through a whole string of acquisitions. But the real turning point, the pivotal moment, was the 1998 merger with a bank called Norwest. Now, they kept the famous Wells Fargo name, but it was Norwest's leadership and their intense cross-selling culture that completely took over. Then in 2008, in the middle of the financial crisis, they bought a collapsing Wachovia, becoming a true giant, but also inheriting a ton of new risk.
And that brings us right back to the modern crisis. With this culture of fraud so deeply embedded in the company, A reckoning was basically inevitable. But the consequences, they were way more severe than anyone could have imagined. We're talking about an unprecedented punishment that threatened the bank's very existence.
The punishment came in the form of this number, $1.95 trillion. Now listen, this wasn't a fine. This was an asset cap imposed by the Federal Reserve. That is a truly rare and crippling penalty. It meant Wells Fargo was legally forbidden from growing, at all. For a bank, that is like telling a shark it's not allowed to swim anymore. In an industry where growth is everything, this was a potential death sentence.
The fallout was immediate and brutal. The CEO, John Stumpf, the guy behind the whole 8 is great strategy, he was forced to resign. The stock price tanked. They brought in an insider, Tim Sloan, to replace him, but he couldn't fix the rot and was gone in less than 3 years. The bank was totally rudderless, it couldn't grow, and it was on the verge of being swallowed up by its rivals.
So with the company in a total freefall, the board finally realized they couldn't just promote another person from within. They needed a savior. They had to make a bet on an outsider, a CEO with a reputation for cleaning up messes, and they handed him what was arguably the hardest job in all of American finance.
And that outsider was Charlie Scharf. He was a longtime protege of the legendary Jamie Dimon over at JPMorgan Chase, and Scharf was known as this methodical, no-nonsense leader. So in October 2019, he takes the job. He's facing a completely broken culture, regulators that are furious with the bank, and that crippling cap on growth. The big question was, could anyone actually fix this mess?
Scharf didn't just come in and tinker around the edges. No, he performed major surgery. First thing, he cleaned house. He brought in a totally new leadership team, all from outside the company. Then, he went right after the two core problems, risk and incentives. He poured a ton of money into overhauling their compliance systems, and most critically, he finally killed the high-pressure sales quotas. It was a methodical plan to attack the scandal right at its roots.
And you know what? The plan is working. The bank has been slowly, methodically checking off all the boxes that the regulators demanded. The ultimate goal here is to get the Federal Reserve to finally lift that crippling asset cap. That move would be the signal to the world that the bank has truly been fixed. If and when that happens, Wells Fargo, with its massive $2 trillion asset base, will finally be free to grow again.
When you look at it, the story of Wells Fargo is kind of the story of America, isn't it? It's this cycle of frontier ambition, massive growth, terrible scandal, and then reinvention. Under Charlie Scharf, it seems to have proven that even a giant institution can rebuild from the deepest wounds. But it leaves us with one final, crucial question. After 170 years of booms and busts, has this American legend really, truly been reformed? Or, in the high-stakes world of modern finance, is history always just destined to repeat itself?